You lost money today, and yesterday, and every day before that.
You can have the exchange report, you can have the CSV export, you can even have the new IRS broker form, and still not know the answer to the one question that matters. What did you actually sell? That is the Bitcoin tax problem most people discover too late. Not because they are trying to hide something, because they assume the form is the record. It is not. The form is the ending. Your records are the story that explains how the ending was calculated. This is exit velocity. I'm Justin. This is educational only, not tax advice. Talk to a qualified tax professional about your own situation. Today we are taking the next step in the paper trail. Last episode, we talked about cost basis methods, FIFO by default, and specific identification if your records are good enough. This episode is what happens next. How those records turn into Form 8949, how Form 8949 rolls into Schedule D, and why the new 1099 DA can help but cannot replace your own Bitcoin records. Here's the trap. A lot of people think tax reporting works like this. The exchange sends a form. The form tells you the number. You enter the number. Done. That may feel familiar if you have a simple stock brokerage account. But Bitcoin breaks that clean little story because your Bitcoin life probably does not live inside one neat account. You might buy on one exchange, withdraw to cold storage, move coins between wallets, send some back to another platform, sell a little, spend a little, swap something, receive something, consolidate UTXOs, change wallets, change exchanges, and then months or years later, a tax form appears. The form may show what happened on that platform. It may show proceeds. It may show a date. It may show an asset. It may show a quantity. It may show basis in some cases, but it does not magically know the full history of your coins if that history happened outside the broker's walls. That is the key idea. A broker form is platform memory. Your records are household memory. And when those two do not match, the form does not save you. Your records do. Form 8949 is where sales and other dispositions of capital assets get listed transaction by transaction. For a Bitcoin holder, think of it as the table where each taxable sale or exchange gets translated into tax reporting language. The basic logic is simple. What did you sell? When did you acquire it? When did you sell or dispose of it? What were the proceeds? What was your cost or other basis? Was there an adjustment? And what was the gain or loss? That is the story. Form 8949 is trying to tell, not as a narrative, as rows. A row might say, on this date, you sold this amount of Bitcoin. The proceeds were this. The basis was that. The result was a gain or loss. Then those rows get grouped into short-term and long-term categories. Short-term generally means held 1 year or less. Long-term generally means held more than 1 year. Then the totals move to Schedule D, where the overall capital gain or loss picture is summarized. So Form 8949 is the transaction detail. Schedule D is the summary. And your records are the source material. If your source material is bad, the rows become guesswork. Let's make this concrete. Say you bought Bitcoin in 3 separate lots. Lot A, you bought 0.05 Bitcoin at a lower price. Lot B, you bought 0.05 Bitcoin at a higher price. Lot C, you bought 0.05 Bitcoin somewhere in the middle. Later you sell 0.05 Bitcoin. That sale has proceeds, but the gain or loss depends on which lot you sold. If your records do not identify the lot, you may fall back to the default method. If your records do identify the lot properly, your tax professional may be able to use that record to report the specific lot. Same sale, same amount of Bitcoin sold, different basis, different gain, different Form 8949 row. That is why this is not an accounting detail. It changes the output. The row on Form 8949 is not just sold Bitcoin. It is sold this Bitcoin, acquired on this date, with this basis. That little word, this, is the whole game. Now let's bring in the new form. Form 1099-DA is the IRS broker reporting form for digital asset proceeds from broker transactions. The IRS says this reporting begins with transactions on or after January 1st, 2025. That means brokers start reporting certain digital asset transactions to taxpayers and the IRS. That is a big change. It means the IRS is getting more structured information about digital asset sales than it did before. But here's the mistake to avoid. Do not hear 1099-DA and think I no longer need records. A 1099-DA is not a personal Bitcoin archive. It is a broker report. It can help identify what a broker processed. It can give you reported proceeds. It may include basis in some cases, but it may not include everything you need. The IRS itself has warned that many 2025 statements may not include basis, and taxpayers may still need to calculate basis to determine gain or loss. That matters, because proceeds alone do not tell you tax impact. If you sold Bitcoin for $5,000, that is not automatically a $5,000 gain. Maybe your basis was $2,000. Maybe it was $4,900. Maybe it was $5,500. The proceeds are just the sales side. The basis is the memory side. Without basis, you do not have the answer. You have half the receipt. This is where a lot of people get frustrated with exchanges. They download a tax report and expect it to be complete. Sometimes it is useful, sometimes it is not. But the problem is not always that the exchange is bad. The problem is that the exchange may not know what happened before the coins arrived. Imagine you bought Bitcoin on exchange A, then you withdrew to cold storage, then 2 years later you deposited some Bitcoin into exchange B and sold it. Exchange B sees the deposit. Exchange B sees the sale. But unless it has reliable basis information from the prior history, it may not know the original acquisition cost. It may not know whether that Bitcoin came from a 2020 purchase, a 2022 purchase, or a mix of lots. It may not know what you intended to identify. It may not know whether the wallet transfer was just you moving your own coins or something else. Your record keeping connects those events. The exchange sees platform events. You see life events. That is the difference. So what should a normal Bitcoin holder actually do? Again, educational only, not tax advice, but here is the practical workflow. Step 1. Keep your own transaction ledger, not just buys and sells, also transfers, wallet movements, exchange deposits and withdrawals, fees, dates, amounts, transaction IDs where available, notes on what the movement was. Step 2. Separate taxable events from non-taxable movements. A sale is different from moving Bitcoin from your exchange account to your own wallet. A transfer between wallets you control is not the same thing as selling. But if your records do not label transfers clearly, they can look confusing later. Step 3. Match dispositions to lots. This is where cost basis from last episode comes back. If you sold Bitcoin, which acquisition lot did that sale draw from? If you cannot support a specific identification, you may not get the method you wanted. Step 4. Calculate proceeds, basis, and gain or loss. That is the math that becomes the Form 8949 row. Step 5. Compare your records against broker forms. When a 1099-DA arrives, do not just blindly accept or blindly reject it. Reconcile it. Does the sale date match? Does the quantity match? Do proceeds match? Is basis included? If basis is included, does it match your lot record? If basis is missing, do your records fill the gap? If something differs, can you explain why? That is the difference between panic and preparation. The uncomfortable future is this. The IRS may receive a broker form. You may file a tax return. If the numbers do not line up, you want a clean explanation. Not a folder of mystery screenshots, not a half-exported CSV from 3 laptops ago, not, I think those coins came from Coinbase. You want a simple paper trail. This broker reported this sale. Here is the wallet history. Here is the lot history. Here is the basis calculation. Here is why the Form 8949 row looks the way it does. That does not mean the IRS will agree with everything automatically. It does not mean you should handle complex cases alone, but it gives your tax professional something usable, and it gives future you a fighting chance. So what should you save? Save exchange trade history. Save broker tax forms. Save CSV exports before accounts close or formats change. Save wallet transaction IDs. Save deposit and withdrawal records. Save notes on self-transfers. Save cost basis by lot. Save fees. Save the method used for lot selection. Save any reports you gave to your tax preparer, and save them in a way that you can understand later. A folder called Crypto Taxes Stuff is better than nothing, but a folder by tax year with exports, forms, wallet notes, and a clean summary is much better. Your goal is not to become a tax software company. Your goal is to make the story reconstructible Because tax reporting is not just about the year you file, it is about whether you can explain that year later. The biggest mistake is waiting until tax season to build the record. By then, you are not recording. You are reconstructing. And reconstruction is where errors creep in. You forget which wallet was which. You forget why a transfer happened. You lose an exchange export. You cannot remember whether a transaction was a sale, a withdrawal, a swap, or a consolidation. You see a 1099 DA number, and you have no confidence in whether it is complete. That is the expensive version of confusion. The cheaper version is boring. Update the record when the transaction happens. Label the transfer. Save the export, write down the lot, keep the trail. It is not exciting, but it is the difference between owning your paper trail and hoping someone else owns it for you. Here is the clean takeaway. Form 1099-D, A is not the enemy. Form 8949 is not the enemy. Schedule D is not the enemy. The enemy is missing context. The broker form may tell part of the story. Form 8949 reports the transaction rose. Schedule D summarizes the capital gain or loss, but your records explain how the rose got there. That is the part nobody can outsource completely. If your Bitcoin is important enough to hold, it is important enough to document. Not because paperwork is fun, because future you deserves a clean answer when the form shows up, and because the exchange said so is not a record-keeping strategy. Next episode, we are going one layer deeper into the part most Bitcoin holders ignore until fees get painful. UTXOs, what they are, why they matter, how they affect self-custody, privacy, and future spending, and why small buys can become a messy wallet later. That is episode 19. For now, own your records before the forms arrive. This is Exit Velocity. Educational only, not tax advice. If this helped, subscribe and start building the paper trail before tax season builds it for you.